Hello? Laura, were you able to turn on the recording? Awesome. Thank you so much.
Okay.
All right. Well, good afternoon, everyone. Thanks so much again for joining us today as we come off the great holiday weekend. I hope everyone had a safe and an enjoyable holiday. We definitely have the A team here from Principal to talk a little bit about our higher cash value solutions today. Not that I'm on the A team, but I'm Michelle Tisch. I'm the Regional Vice President in the Midwest for the Life Insurance Solutions. Hopefully, we'll have two of our top product managers on the line with us today. They bring a lot of knowledge and expertise, and they'll talk about the ins and outs of our higher cash value options and the products that support them. Hopefully, we'll have both Dan Goodhue, who is our product manager for our index solutions, and Todd Jones, who is our product manager on the variable side. Also with us today, we have Dan Hardy. Many of you are familiar with Dan. He is on the business team, and he has been helping Advisor bring solutions to business owners for several years. An excellent resource, very knowledgeable, and he'll talk a little bit about how the products fit into the different business solutions. So our agenda today is we're going to talk just a little bit about the need for higher cash value, kind of the how and where it fits. We'll go through both the index and the variable solutions and talk about how they work and look at some numbers. As we go through each one of those, we'll look at some case studies and kind of see the products in action, see how do they fit into what the business owners are really looking for. And then finally, we'll talk about some underwriting options. It's wonderful to know the product, but in order to be able to actually get a case placed, you have to be able to get an underwriting offer that works. And Principal brings a lot of ideas and solutions that can help you there. So before we jump in, I just want to give a little background. Higher cash value, a lot of people refer to these products as higher cash value, but they also call them COLI or BOLI, so corporate-owned life insurance or business-owned life insurance. And I get questions sometimes on how are these products really different than just the street-level products, the cash value products. And typical cash value life insurance is going to show pretty low cash values and low surrender values in the early years due to the surrender charges that do apply there. And for businesses, this may not work very well from an accounting perspective, because if they pay $10,000 for a life insurance solution, they may only be able to show $2,000 or so on the books. And on the balance sheet, that looks off. And business owners like to have the expenses and the assets match from year one and all the way through the life of the product. They love to have the assets exceed the expenses, of course, which life insurance does in later years. But the higher cash value brings those first year values either equal to or closer to those first year premiums so that there's not as much of a hit to earnings, is the phrase that a lot of people use on the life insurance books. So the early cash values can be really critical to business owners who use a lot of loans or they carry some debt in their business and on how their business operates. And the bankers really like to, again, see the assets being equal to or greater than the expenditures. So as we go through some of these, we're going to see that Principal has several great options to be able to get those higher cash values. One thing to keep in mind, you'll hear a lot of carriers talk about their COLI solutions and their COLI offerings. And most require that the corporate-owned life insurance or the higher cash value products be truly corporate owned. And Principal does allow our products to be used in business solutions, even if they're personally owned. So things like executive bonus or buy-sell business succession plans, where they are individually owned, we can still use some of these solutions. And so sometimes that does come into play. That need is there on those types of situations. So we'll move into the index UL Accum, and I just wanted to see if Dan is out there. Dan Goodhue, were you able to jump on? You'll have to #6 to unmute your phone.
Great, Michelle, can you hear me okay?
He sent me a message.
I Dan, yes. Thanks so much for jumping on. I'm glad you made it. I'd like to introduce Dan, Dan Goodhue. Dan has a great understanding of the index market, kind of the ins and outs of the different pricing strategies, and he brings a lot of expertise to the discussion. So Dan, I'll turn it over to you to highlight our index solutions and our high early cash value options.
Great. Thank you, Michelle, for the warm welcome, and thanks everybody for the time today to chat with you on about our IUL product. We'll have, as Michelle mentioned, we'll have Todd on a little bit later to talk our variable offerings as well. But I am the IUL product manager here at Principal, and wanted to go through some of the highlights of the product that we offer that fits within the high early cash value space. So as the name suggests, in IUL Accumulation 2, this is a product built for max funding or near max. Generally, say 75% of max or more is kind of the typical funding amount that we'd look for with this product. Target ranges would be the folks that you'd imagine would be willing to max fund a policy like that, say age 35 to say 55. These are folks that want cash value growth without direct participation in the market via a variable product or funds or other ways. Kind of as a way to diversify their assets. Some will refer to it as kind of a Roth alternative for those that are capped in Roth contributions. So we're really looking for folks that are able to put some money into a life insurance product with these things. So common case designs with our IUL A2, IUL Accumulation 2 product is personal retirement planning, business owner retirement planning, executive benefits for businesses. And in those business concepts, that the high early cash value rider that we offer does help to kind of levelize that balance sheet, as Michelle mentioned. So the kind of core benefits of the product, features, functionality that we offer, there is an account value enhancement in years 11 on, a guaranteed 75 basis points credited to the net accumulated value. This kind of helps to enhance the concept of zero is your hero for 10 years, and then 75 basis points is your hero. It doesn't rhyme as well, but in years 11 plus. We do have a high cap account that offers some more exposure for more bullish expectations. There's a 1% segment charge in exchange for a higher cap as an offering. The beginning of segment charge means that the segment needs to return at least as much as that charge more than the non-high cap account in order to outperform in the short term. But over a long period of time, if you're bullish, the index tends to be at the floor and cap more often than not. And historically, at least, the high cap accounts do look a little bit better than non-high caps if you're willing to pay that 1% charge. We do credit interest based on what we call an adjusted segment balance. And what that does is it gives you credit for the time that credit charges, partial surrenders and loans were in a segment, meaning if you take a partial surrender in the 11th month of a segment and values removed from a segment, some carriers won't credit interest based on the 11 months that partial surrender was there. We're actually applying credits to that amount that was there for 11 months. We also have something called scheduled surrenders and loans. Internally here, we call them SSLs because we throw acronyms at everything. But basically what that does is with a single form, we'll allow you to set up a stream of income. We'll recalculate that distribution amount annually with an end cash value in mind. We'll automatically switch from partial surrenders to loans when your premium is removed, and we'll automatically activate the life paid up rider to help avoid that kind of phantom tax when your policy is heavily loaned. We do offer two loan types. Standard policy loans is, as the name suggests, kind of the standard zero net cost loans in year 11 plus, and the other is our alternate policy loans, which in years 4 on, you can take a loan that will allow interest to credit at whatever the index is crediting in exchange for a fixed charge that's currently at 5%. So onto the high early cash value feature that Michelle mentioned, and what this is all about. The alternate surrender value rider is a rider that we offer for business use only. It has a 5-year guaranteed return of premium. So premiums paid for the first 5 years are cumulatively added up, and that's what would be available as a full surrender. Offered ages 20 through 70 for business-owned or sponsored cases. There is a funding requirement. You have to fund it at least at 75% of MAC in order to get the benefit. And there is a charge for the benefit of 4% of premium charge in the first 7 years. So most commonly used on bonus design, loan split dollar, things of that nature where that balance sheet offset is necessary. As far as riders, I won't get into the other riders, but we do offer kind of the whole suite of riders that accumulation products tend to have, including a chronic illness rider, the life paid up rider, which I mentioned, high yearly cash value, salary increase rider, which I do want to note is available, but if you're max funding a policy, you typically don't want to use that, or at least you need to be able to illustrate it to make sure the benefit can be used. Waiver of monthly policy charges and child term is also available. So go ahead and switch to that next slide. So the 3 accounts we offer, I mentioned at a high level that we have a high cap account. It is 400 basis points higher cap, and that's again in exchange for a 1% charge. Both the price return and the price return high cap accounts track with the S&P 500 that you would see out on any print or televised news source. Crediting is based for both of those on a point-to-point crediting. The total return account uses a monthly average crediting instead of point-to-point, and it tracks with the total return of the S&P 500, which isn't as visible as the price return. The total return actually includes the value of reinvested dividends, so there's a higher base to that index value. But because there's monthly average crediting, it tends to lag in a slightly bullish period, where it will really excel is in a very bullish period or in a highly volatile period due to that monthly average crediting. Max rates for those accounts, the price return and total return are 592. The high cap account is 763. So that was a lot of information on IUL products, but wanted to get through them quickly so we left time for everybody else, and happy to answer questions either now or at the end.
We'll probably go ahead and take questions at the end and just kind of jump into the details on the IUL high yearly cash values.
Sounds great. So as I mentioned, the ultimate surrender value rider is our high yearly cash value rider on this product. And the 2 slides I have here, there's a lot of numbers, but really just want to draw your attention to the red and the blue squares in here. So on the left, we have the base policy with no rider. In the middle, the blue section we have with the rider. And then to the far right, we're comparing the 2. So you'll notice that in the red square, the red rectangle with the rider, it's a return of premium for 5 years. And in years 6 through 10, it's less than premiums in years 6, 7, and 8. And then in 9, we're up above premiums again. The reason there is the formula will do 80% of premiums, 20% of account value in year 6, and declining opposite scale all the way throughout. The goal of the rider is really to give as much value that they put in back as possible, and this was the cleanest way to do it. When you compare without versus with rider in the far right column, you'll see that with the rider, it far exceeds it early on, and the further you get into the policy, the more the policy would have done better without it, but really due to the value that the rider is supposed to be providing, we're focusing more on those first, say, 5 or 7 years. If you want to switch to the next slide. Okay, this slide is nearly identical to the one before. The difference is we're running at a 0% rate of return. So this would be a worst case scenario. Issued a policy, and for 10 years you get a 0% return. You'll notice for the first 5 years you still have a guaranteed return of premium in the rider section there in the middle, and that's the real value of the rider. Doesn't matter what the market does. As long as you fund it properly, you will get your return of premium for 5 years. And then in the 6th year, it doesn't fall off a cliff here. It still is providing a fairly significant amount relative to no rider with a 0% return. And that's the real value of the rider. We're giving as much premium back as we can over the course of the rider duration. When you compare the 2 in the far right, again, early on, it's significantly, way significant versus a policy without the rider. And again, as time goes on, the value of the rider starts to diminish until the rider falls off after the 10th year. Michelle, was there anything you wanted to add to these?
I think that as Dan Hardy will talk a little bit about the case study, it'll verify where these fit the best. But I think you did a great job talking about it. I mean, that first 5 years, having that guarantee of the return of premium is very significant. And there aren't other carriers that have that type of a guarantee. I think ours is the only one that truly has a true guarantee of premiums. Others will have various formulas, but ours, I think, is the only one that works exactly like this. So it's got a lot of interest.
Yes, very much so. Yep. Thank you.
Absolutely. Thank you so much, Dan. Appreciate the great overview and then showing how the rider works. Clearly, those high early cash values can do a lot to help a business owner as they're working through how do they fund a particular scenario. And so now I'd like to have Dan Hardy talk a little bit about a case study that we've worked on where we actually did use this rider and saw the benefits of it. So Dan, do you want to take it away?
Michelle, can you hear me okay?
I can, yes.
Okay, perfect. Just wanted to make sure I lost connection to internet here, or for any of you here in Des Moines, we're having some storms roll through. I think we're the bullseye of a few storm systems. So anyway, I really appreciate everyone's time here today. And I just want to talk through a quick case study here on a bonding case with a construction company that we were looking at. As you see on the screen here, this is a 52-year-old male, and this is just based off a sample case. We've got a lot of cases that are like this, some that are maybe slightly smaller, and some that are actually substantially larger. So kind of fits right in that opportunity where it's scalable in both directions. This type of sales idea is really applicable most to the construction company. So anyone who's working in that industry, this may be a good fit for you. Other industries, I'd say probably the one that we see the most or second most is contractors. And really the idea around bonding assets are companies have to have assets on the balance sheet for instances where they fail to complete a job or fail to meet contract specifications. And typically those assets, those bonding assets, have had to be in the form of liquid cash. So cash sitting in a savings account or a checking account. And I think we all know the paltry amounts that those accounts are paying currently. And so the idea here is with the use of this higher cash value rider, you can actually take those same amounts with that 100% cash surrender value, especially on this IUL product, and you can use these for bonding assets. Now, most bonding companies will take these or accept these, but you'll want to work with the bonding company to make sure that that's something they will accept. In this particular case, the client one step further actually had key person needs. So they were previously had a term insurance policy in place. And in a lot of cases like this, they say, oh, well, it's yes, that's providing value because we understand that that key person passes away. We're in a world of hurt, but we want to really do double duty with these dollars. And so they were willing to pay a little bit more, or actually a good amount more, to not only have the 100% cash surrender value in the early years for bonding assets, but also to cover that key person need. And to do it, take it even one step further, they said, yeah, we're even more happy because we're paying them this additional amount, but the value we're seeing in return is substantial. It's 100% cash surrender value on the balance sheet, so it's like moving money from our left pocket in the corporate account to the right pocket in the corporate account. They were able to use those cash values in the future for a buyout of a partner or other expansion opportunities. Or the third idea that I had was for retention of key employees, and that's something that, especially those specialized construction individuals, there are a lot of companies that want to retain those folks, and you can use these assets in order to do so with a lot of different plan designs that we have. The longer the asset stays on the balance sheet, the better. So in this particular case, if you just look at year number 15, they've paid in about $400,000. They've got $530,000 on the balance sheet. They've had $130,000 roughly of growth. that's non-taxable because it's in a life insurance policy. So that's one thing that this particular case, this is a great fit for these high early cash value rider products or high early cash value products. We're seeing a lot of activity, and I'd say construction companies and contractors are probably the two industries that we're seeing this most. So Michelle, I'll kick it back over to you. That's one opportunity that we're seeing with a lot of advisors across the country.
Great, thanks so much, Dan. And as you can see, with the values being equal to the premiums paid and then quickly exceeding them, as Dan pointed out, this product has gained a lot of momentum and definitely does get a lot of interest. A couple things that we might want to mention. When you do use the high early cash value, it does spread your compensation. So the first year comp is a little bit lower, and then you have more of a levelized compensation spread years 2 through 4, and there is a chargeback for the first 3 years. A lot of people find that very acceptable because you have a 5-year guarantee of first year or of premiums that you can account for in the high early cash value, whereas the chargeback is only for the first 3 years. It does grade down over that time period as well. So we'd be glad to answer any questions if you have specific cases on what those things would look like, but just kind of good to know that that's how this product would work when you have that high early cash value option. I'd like to introduce Todd Jones now. Todd is another excellent resource in our product management area. He focuses on the variable life insurance products and is the product manager there. And I've seen a great pickup in interest on our our executive VUL product specifically, because as we reintroduced it for all of the changes of 2020, we did kind of expand where and how it can be used. And so it can be used in some of these products or these designs that we're talking about here. And so I'll turn it over to Todd to give us an overview of kind of the product and then how that high early cash value option works as well. Todd, were you able to unmute your phone?
Are you able to hear me?
I am, yes. Great. Thank you.
Okay, very good. So Executive VUL III is our institutionally priced variable universal life product. So ages 20 to 75, as has been alluded to earlier, needs to be company owned or sponsored to use these kind of riders where you're getting high early value up front. Minimum base of 100,000. So that's inclusive of base. And if someone happens to term blend with our supplemental benefit rider, that's the total min that you need to meet on a face amount. Death benefit option, 1 and 2, as you would expect. We also have death benefit option 3 available as well. Riders, nothing extremely distinctive here. So change of insured is a little bit important in that our asset-based charge does decline over time. So if an executive leaves, there is some benefit to bringing a new executive onto that policy to have the same point in time that the prior life was on. Death benefit guarantee to age 85, not real important on this product. And it's not a lean and mean kind of guarantee. It's just a cumulative premium kind of test. That's not why anyone's looking at this product by any means. Enhanced cash surrender value rider. So this is very important, and I'll get into this a little bit later in our slides. So our enhanced cash surrender value rider on this version of EVUL has a lot more flexibility than what you had with our prior version, which was EVUL II. And I will show you some numbers that will help kind of elaborate on that point. Dan Goodhue did a great job of mentioning our life paid up rider. So that's a rider that automatically pops as long as they've met the terms and conditions of the rider. So they've been in the policy 15 years. They've taken all their premiums out. They are age 75 or greater. I mentioned term blend, so supplemental benefit rider. So our prior version, EVUL II, had this as well. So it didn't get used a whole lot because when you use that term blend rider, you're proportionately reducing your compensation. So kind of the theme and the key takeaway today that I want you to have is now all of a sudden with EVUL 3, I've got two different ways that I can influence long-term values for the policyholder. So I've got the ability to term blend, which I'm going to trade off compensation to do that, and people tended to not do that. The other thing that you have now all of a sudden is this more flexible enhanced cash surrender value rider. So that's going to be a big deal as you work with Michelle and Laura on cases and Dan going forward. So go ahead and go to the next slide, please. So I don't want to get real in depth on the investments. I will say this, we've pretty much got everything you could ever think that you need to have. So we've got over 125 different investment options, all of the typical suspects that you would expect to be on there. So like Capital Research and Management Company, that's American Funds. We've got roughly about 6 options from them. We've also got target risk and target date funds if you want to keep it simple and not think about an asset allocation exercise. We've got those available. Those are through Principal. The other thing that I will say, and I think this is important, is I have added a lot of indexed options over time. So not index linked accounts, so no fixed index linked accounts, but index options. And to kind of give you a high level on that, so there are 8 different index options effective June, because I'm adding one more. So it'll be 8 come June. And those really cover the gamut. And I kind of always say to folks, it's like, you know, don't think in terms of a lake or a pond, think in terms of an ocean. So I've got Fidelity's International Index that gets into foreign and emerging markets. Something that's pretty unique, Vanguard Global Bond Index, gives you investment grade kind of bond exposure and fixed income at a global level. And, you know, I always kind of say to people, you know, it's great to think big, but just don't think big when you're investing. You know, make sure you're getting your small and mid-size exposure. And I've got a variety of options on the products that do that. We've got a Vanguard Mid-Cap Index, Fidelity Extended Market Index, which gets you into small and mid-cap exposure, a Russell 2000 option. If you want to think big, S&P 500, we got that on there. Fidelity Total Market Index, which gives you exposure to kind of the gamut of U.S. sized companies, large, mid, and small. And then for just straight up fixed income that's domestic, we've got a bond market index. So you've got really good flexibility with finding things that are kind of efficiently priced and passive from an index perspective. And then if you want something that's actively managed, we certainly have the gamut there from a style box perspective. Go ahead and go to the next slide, please. So as far as case requirements to use EVUL 3, we've already hit on the business sponsored and owned. One of the requirements with this being institutionally priced, and I never viewed this as a big hurdle, is you need to have 25K of year one premium. So what do you mean by that, Todd? So basically, any means that you can meet that 25K year one premium on a case, not on a policy level, on a case, between recurring premium, 1035, single premium, you're good to go to use this product. So we are looking for it to be funded significantly. So we want to fund it at least 75% of MEC to be able to use the product. So one of the things I tried to hit earlier, and this will bring justice to this, is the enhancement factor is a lot more flexible. So if you would look over to the right, on the prior version of EVUL 2, go midway down my chart, you basically had only the equivalent of the 50% enhancement factor. And so that would give you like roughly about 103% in year one, net surrender value relative to premium. And then it would give you a year 20 IRR of 6.7%. So that was your only choice with EVUL 2. So now all of a sudden, with EBUL 3, we're saying, you know what, advisor and potential client, there's a lot more case design flexibility for you. So let's take my 50% example. And let's say your client says to you, you know what, I don't need 103% in year one. I don't care about that. Can you help me accumulate better over time? And you'll be able to say to that, well, you know, we can look at that and we can go as far down as 25% or no enhancement factor at all. And I'll take the no enhancement example. So there you're still close to 100%, assuming an 8% return. I've got all my illustration dynamics listed below. And all of a sudden now I've picked up 14 basis points of long-term IRR over 20 years relative to that 50% level of enhancement factor. So a lot more case design flexibility, and basically it says this: if you don't care about the extra juice up front, don't pay for it. Go for the longer term accumulated value. So something else that is distinctive with this new design is all of a sudden you can go up the scale of enhancement factors to 75% and 100%. So the requirements to do that are you've got to have a case that is $250K plus of year one premium, and it needs to be business owned. So now you're starting to get into the realm where they are maybe really sensitive to what their books look like, and all of a sudden 107 to 108% looks good to them in year one up front, and they're willing to trade off that year 20 IRR to achieve those high early values. So basically think of it as a pendulum. You can kind of decide, you know, how important are those early values versus long-term values. Lower in my slide to the left, I feel like I've hit the investment options pretty good. We do cover most of the Morningstar style boxes, so I'm very confident that you'll pretty much find any kind of investment option that you need to fit your client's situation. So what if you had a case where you wanted VUL and you happen to not be able to meet that 25K year one bogey from a premium perspective? So we do have an option on our retail VUL, which is VUL Income IV, and you can use what is called the surrender value enhancement rider on that, as long as it's business sponsored or business owned, and that's a common theme across all of these products. What does that do for you? So it'll give you first year values that are in that 95% range of premium paid. So if you'll recall from the prior slide, you know, my worst option there was more like in the 99.5% to 100% range. This is a little bit lighter, but what that will do is it will give you better long-term accumulation and most likely better long-term income out. So if that's really the focus of your case, this is where Dan Hardy, Michelle Tisch, Laura Bass are going to have you start. They're going to have you start looking at this. So the other item that is distinctive is this happens to also, just like Dan's product on the IUL side, have the chronic illness death benefit advance rider. So our institutionally priced product does not have that rider available. So if that's a driver on your case, you're going to want to look at the VUL Income IV. There's no minimum premium requirement. And again, as I had said earlier, there is a requirement to fund heavily, just like on EBUL 3, at 75% or more of MAC. And that is all I have, and I will turn it over to Mr. Dan Hardy.
Perfect. Thanks, Todd. And back here, one of the things that really resonated with me, Todd, that you talked about is with VUL Income IV, the chronic illness rider there, the SVER rider, that being available on corporate-owned policies, where a lot of times we are using this higher cash value rider. That's pretty atypical. I think there's only maybe one, possibly two other carriers that allow that chronic illness rider on corporate-owned policies. So a lot of benefits in doing that if you're going to use the policy for a retention standpoint or rolling out to an owner for a buyout. Just an added benefit and something that you pay for when you utilize it. So there's no additional cost up front to that rider. And it's a great fit on corporate-owned policies where we're blending that with a higher cash value. So moving on to this EVUL slide. This is a case where, again, we're looking at buy-sell funding. So they chose, in this specific case, the EVUL because of the annualized premium outlay. It's a pretty healthy plan, coming in at $500,000 per year from a funding standpoint. We chose, for this specific case, we chose the 50% enhancement factor. So on that dialable scale that Todd was talking about and Michelle mentioned, we're really coming in at about the middle point here. So they could dial in a little bit higher upfront cash values. They could dial in a little less on the upfront cash values to enhance those longer term cash values. They kind of went right in the middle of it. And so let's look at how that actually kind of plays out. So in the first year, they put $500,000 into this policy. It's a 45-year-old male, preferred non-tobacco, healthy death benefit, just shy of $12 million. Net surrender value in year number one is $508,000. And if you look at the long-term value, so it's like jump down to year number 15, 7.5 has been paid in, and based on a 6% net rate of return, we're looking at about a $10.7 million net surrender value there. So again, they enhance the cash values up front with that 50% enhancement factor. Could be a little bit higher, could dial it down just a touch, but really a very healthy amount in the 10th year. So that's the big piece there. And so again, they wanted to have that on the balance sheet. They also wanted to have it available for buyout purposes if they did need to look at buying someone else out at another point in time. They've got great policy values at early years as well as more of those longer term years as well. Could use the policy for death benefit purposes if a partner passes away, unfortunately, or more the living buyouts that we're looking at. So if a partner is divorced, as an example, or and that's in their buy-sell agreement, or hopefully departs from the business on a voluntary basis like retirement, that's going to be another key piece there. So again, great product for those types of situations, and we've got some ways that we can streamline the process for you and for your clients from an underwriting standpoint. And so I'll flip it over to Michelle to walk through those.
Great. Thanks so much, Dan. And yeah, hopefully the information that Dan and Todd and Dan shared gave you a great idea of how our high early cash value options might fit some of the business cases that you work on. I do want to talk a little bit about underwriting, because once you found the case, we have to get you a great offer so that you can place it. And we do have a number of options. They range from accelerated underwriting through guaranteed issue. And so I'm just going to kind of run through these quickly. From a fluidless underwriting perspective, most of you are probably very familiar with accelerated underwriting. We've had that for quite some time, but a lot of people weren't necessarily aware that you could use accelerated underwriting with our corporate-owned life insurance type solutions. And you can get up to $1 million just like you could with any other individual product. It is available on all products up to $1 million. Again, we're looking for healthier individuals that don't have any major health impairments. They have good build, and they can go anywhere from standard to super preferred risks as far as that spectrum. So accelerated underwriting for up to $1 million is available. And when you're looking at these types of solutions, a lot of times, if they're heavily funding at 75% to 100% of MEC, they are looking to minimize the death benefit many times. And so $1 million may get you where you need to go with these types of policies. But if they don't, we are, as many of you know, we do have expanded fluidless guidelines in this time period, just because we know that right now people do not want to be face-to-face with anyone. They don't want an examiner to come into the home. They don't want to go through that very personal experience. And so we have temporarily expanded our Fluidless guidelines so that if you're up to age 40, you could get up to $2.5 million potentially. And if you're 41 to 60, up to $2 million without having a new exam done. So we're still looking for those same fairly healthy individuals with no major health impairments, good build. And the key here is that they've had a physical within the last 24 months that included blood work, and that we can get that. And we'll use that blood work. We can access that through many different aspects, and Principal will try to get it as much as we can on our own, or we might have the client help us get that through a human API site. But if we can access that information and use it to get an offer out, we can, again, get up to those higher face amounts. So great options to get a policy done on a fluidless basis. Of course, if they want more than this, we can certainly do full underwriting. Principal has excellent full underwriting capabilities, and we are able to use our healthy lifestyle credits and our ASAP, or our automatic standard approval program, which is really table shave, to help get great offers to you on these products. And so those are always available, of course, to do a full underwriting type of scenario. A lot of people, when you're looking at these types of policies, they have a number of lives and they want to do a guaranteed issue type of format. So if you were looking at any of the corporate-owned or business-owned products that we've talked about, we would be looking at the permanent product side, where we would be looking at the guaranteed issue. We need 10 or more eligible lives. We define eligible as white-collar management type folks making $75,000 or more. So they may or may not be considered executives. Many times they're management, but they're higher level individuals. So for any of the products that we talked about today, if you had 10 or more of those eligible lives, we would be able to get you potentially guaranteed issue. We would run it through the underwriters and make sure that we could get approval on that. And they would tell us, what the maximum amount we can get would be. It's really based on the number of lives that are included in the program. And so we would be able to tell you how much coverage we could get. It might be, for 10 eligible lives on an employer-owned type of policy, it's usually about $400,000. And then as you get more and more lives involved in the plan, that goes up significantly. We can have employee-owned scenarios go through guaranteed issue as well. The multiples are just a little bit less. And then you can see I do have the guaranteed issue term parameters there. We didn't talk about term insurance today, and we're not really going to get into it. I did just want to remind you, though, briefly, since we were talking about guaranteed issue, that we recently introduced guaranteed issue term. It is for 25 or more eligible lives, defined the same way as far as that $75,000 income and white-collar management. But it gives you an idea, another option, if you have someone who is looking more for that death benefit coverage. Or we've seen plans where they have a large number of people and they may do guaranteed issue, a combination of both, where they want to get death benefit coverage on everyone, but they want to do some funding for, maybe retirement buyouts rather than just death, and they put in some guaranteed issue permanent on just a subgroup of that. So certainly glad to work with you on how we can make these solutions fit your particular business cases. And, keep in mind that all of these cases that we talked about are really seen as a solution to a need from the business owner's perspective. They had some type of a buy-sell need, a key person need, and they bought that life insurance policy as a solution to that need. So it really is a plan to them. And Principal's really the only carrier that's going to administer that as a plan, regardless of what you're trying to do. It could be a one-person key person plan. It could be a buy-sell plan. It could be some type of an executive benefit. And we would provide full plan level administration on that on a complimentary basis. We would help you from a plan administrator. The plan administrator would be available to call. They would provide list billing. they would provide annual statements that have all of the tax reporting information that's needed on there. And that's really important when you're talking business-owned life insurance, because there are some rules regarding 101J and other rules that those business owners need to make sure they meet to keep that death benefit on a tax-free basis. And so we'll help with all of that. And again, unless it's a true deferred comp plan, we're going to do all of that on a complimentary basis. So at this point, if you want to unmute all lines, Laura, we'll go ahead and unmute and see if anyone has any questions or thoughts that they'd like to share, and we'll make sure we get the right expert on the phone to answer any questions that are out there. Any thoughts or questions from anyone? Well, very good. If there aren't any, first I'd like to thank the presenters, Dan and Todd and Dan. I really appreciate you guys taking the time to share more about our products and how they can be used in business solutions. And really want to thank everyone who was able to jump on. We do appreciate your time. Hopefully this gave you some thoughts and ideas where some of these products might fit. And we hope that if you have any questions, you'll reach out to Laura or I. All of us are very glad to help, but Laura and I are always glad to kind of help get you to the right person to answer any questions that you might have. So with that, thank you all again very much and have a great afternoon.
Thank you.